Gentlemen, let me tell you something the market won't whisper. It will scream it at you after it's too late. The big money is not in the buying or the selling, but in the waiting. Now, that's not just a quote. That's the difference between the 1% who make a fortune and the 99% who walk away defeated. The big money is not in the buying or the selling, but in the waiting. Those words from Jesse Livermore capture one of the deepest truths about trading, a truth so simple that most traders overlook it entirely. Patience, not action, is the real currency of success in the markets. Yet in a world that glorifies speed, constant movement, and instant gratification, waiting feels like failure. That is why most traders never reach the level where real profits are made. They want the rush of doing, not the quiet strength of enduring. Every trader begins with ambition, to make quick gains, to turn small sums into large ones, to prove they can outsmart the market. But the market does not reward those who rush in. It rewards those who wait long enough to let probabilities, cycles, and human psychology play their part. The majority act as if success depends on constant trading, as if more effort means more money. Yet, in trading, effort often means interference. The more a trader meddles with their positions, the more likely they are to ruin them. Livermore understood this. He knew that after doing the hard work of analysis and decision-making, the most difficult part was not taking the trade. It was waiting after the trade was placed. Patience is not inactivity, it is disciplined inaction. It means sitting still while your emotions scream for movement. It means trusting your judgment long enough to let the market prove you right. The temptation to act, to take profits too early or cut losses too soon, destroys most traders. They forget that the market moves in waves, and every wave needs time to unfold. The professional trader knows that price moves are not instantaneous, they evolve as mass psychology shifts. The crowd needs time to believe in the trend you already saw forming. That waiting period, uncomfortable and uncertain, is where true wealth is built. Impatience is the hidden tax of trading. It costs more than commissions or spreads, it costs opportunity. A trader who cannot wait for the right setup trades every setup. They confuse activity with productivity, and when losses come, as they inevitably do, they believe the strategy failed, not realizing it was their lack of patience that failed them. The irony is that they often abandon their method right before it begins to work. Livermore saw it happen countless times. Traders would suffer through a drawdown, lose faith, quit, and watch the same stock move exactly as they had predicted. Only without them on board. Waiting also separates intuition from impulse. Anyone can make a quick decision under pressure, but few can hold that decision when everything seems to be going wrong. Patience is proof of confidence. When you wait, you are saying to the market, I believe my analysis more than I believe my fear. That is strength. And that strength compounds just like profits do. The more you practice patience, the less reactive you become. You begin to see how short-term fluctuations are just noise in the larger rhythm of price. You stop chasing every move and start positioning yourself for the real ones. The big trends that make fortunes, not fractions. Of course, patience should not be confused with passivity. Waiting in the Livermore sense is an active watchfulness. It means you have done your homework, placed your bet, and are now observing with awareness but without interference. You're not hoping, you're allowing. The market will do what it always does, oscillate between fear and greed, and you are simply giving it room to confirm your insight. The undisciplined trader, on the other hand, cannot bear uncertainty. They constantly tweak their trades, jump from strategy to strategy, trying to avoid the discomfort of not knowing. But markets thrive on uncertainty. The moment you accept that you cannot control outcomes, only your actions and reactions, you gain a trader's real power. Patience is a filter. It eliminates noise, distractions, and emotional traps. It keeps you aligned with your long-term plan. When you wait, you give yourself the chance to be right, not by luck, but by design. The market rewards those who can endure boredom, silence, and doubt, because few can. The majority will always seek excitement, and that excitement will cost them. The patient trader is rare because waiting feels unproductive. But in truth, it is the most productive act of all. Jesse Livermore's career, filled with massive wins and painful losses, taught him this rule through experience, not theory. He learned that impatience led to ruin while patience led to fortune. The same holds true today. Technology may have made markets faster, but human psychology hasn't changed. Fear and greed still rule, and patience still wins. So when you're in a trade, and the market seems to be moving too slowly, remember Livermore's wisdom. The big money isn't made by jumping in and out. It's made by having the courage to wait while others lose theirs. Most traders do not lose because their analysis is wrong. They lose because their emotions overtake their judgment. The stock market, as Jesse Livermore often observed, is a mirror that reflects human nature. Fear, greed, doubt, and impatience. It is not the market that destroys most traders, but their inability to master these inner forces. They quit, not not because the system is broken, but because their own psychology betrays them right before success arrives. The truth is uncomfortable but universal. Trading is not just a test of intellect, it is a test of temperament. When a trader enters the market, they step into a battlefield of emotions. Every tick, every swing, every sudden reversal is designed to provoke a reaction. The beginner sees this movement as a call to action, a reason to buy, sell, or panic. But what they do not realize is that the market feeds on such reactions. It lures traders into emotional traps, pushing them to abandon their plans at the exact wrong moments. As Livermore said, the market is never wrong. Opinions often are. What he meant is that the market doesn't punish the strategy, it punishes the lack of discipline to stick to that strategy when emotions flare. Fear is the first assassin of trading success. It whispers in your ear that your position is doomed, that you're about to lose everything, and that you must act now before it's too late. Under its influence, traders cut their winners short or exit just before the market turns in their favor. They mistake temporary discomfort for danger. Ironically, the moment they quit is often the point of maximum opportunity, the point where patience would have turned loss into profit. The market tests conviction by shaking out the weak hands, and most traders, driven by fear, fail that test. Then comes greed, the twin force that can be just as destructive. Greed tells the trader that they can't lose, that the market owes them more, and that risk no longer applies. Ignoring reality, encouraging overtrading, oversized positions, or chasing after moves that have already run their course. When fear causes traders to flee too early, greed drives them to stay too long. Both emotions create the same outcome: loss, frustration, and the illusion that success is impossible. The tragedy is that most traders don't realize they are quitting right before they were about to win. Every experienced trader has lived through a moment when the market seemed unbearable. When drawdowns felt endless, confidence disappeared, and quitting seemed like relief. But if they had just endured a little longer, they would have seen the cycle complete. The market rewards endurance because few possess it. The 99% surrender when they can't handle the emotional pain of waiting, while the 1% understand that pain is the price of progress. Livermore himself experienced this countless times. He knew that even the best strategies fail if the trader cannot manage their own emotions. He once said, "After spending many years in Wall Street, and after making and losing millions of dollars, I want to tell you this: it was never my thinking that made the big money for me. It was always my sitting tight." The act of sitting tight isn't just physical, it's psychological. It means resisting the urge to react to every fluctuation, every doubt, every emotional impulse. It means trusting the plan even when fear demands surrender. What most traders don't understand is that emotion is data. It tells you what the crowd is feeling. When you feel panic, others do too. When you feel greed, the crowd is also greedy. If you can observe these emotions without obeying them, you gain an edge. Emotional awareness becomes your compass, guiding you to act when others freeze and wait when others rush. But that requires a level of self-control that most traders never develop. They let their feelings dictate their trades, and the market punishes them not for their analysis, but for their inconsistency. Quitting in trading often feels like relief, but it is really regret disguised as logic. When traders give up after a losing streak, they tell themselves the market is rigged or that success is impossible. In truth, they were just one emotional test away from a breakthrough. The market doesn't destroy dreams, impatience does. The moment of maximum discomfort often precedes the moment of clarity, but only those who endure get to see it. Livermore's wisdom still echoes through time: the market doesn't beat you, you beat yourself. To survive and thrive in trading, one must master the mind before mastering the charts. The difference between the trader who quits and the one who wins lies not in skill or intelligence, but in emotional endurance. When fear whispers, quit, and patience whispers, wait, the outcome depends on which voice you listen to. The 99% quit right before they're about to win because they listen to emotion instead of reason. The 1% learn to be still in the storm, and that's why the market eventually bends in their favor. A man must believe in himself and his judgment if he expects to make a living at this game. That's why I don't believe in tips. Jesse Livermore's words slice straight through the illusions of modern trading, that success can be bought, borrowed, or copied. In reality, every great trader stands on one foundation: self-belief. Without conviction in one's own analysis, decisions, and instincts, no strategy can withstand the emotional storms of the market. Self-belief is not arrogance, it is the quiet confidence that allows a trader to act decisively and stay the course when uncertainty reigns. It is the invisible edge that separates those who follow the crowd from those who lead it. Most traders begin their journey seeking shortcuts, the magic indicator, the perfect mentor, or the secret formula that guarantees profits. They want certainty in a world built on uncertainty. So, they cling to the advice of others, chase the latest trend, or follow every online guru who promises to decode the markets. But trading by borrowed conviction is like sailing with someone else's compass. It may point north, but not for long. The moment conditions change, fear creeps in, and without inner belief, the trader loses all direction. That is why so many fail. They never learn to trust their own judgment, so when pressure mounts, they crumble under doubt. Self-belief in trading is not blind confidence, it's earned confidence. It comes from doing your own analysis, making your own mistakes, and learning from every loss. Each failure, if studied, becomes a lesson that strengthens your conviction. The trader who believes in themselves doesn't rely on luck or opinions, they rely on understanding. They know why they took a position, why they will hold it, and when they will exit. That clarity creates resilience. When the market turns against them, they don't panic, because they understand that temporary adversity doesn't mean permanent failure. They've built their confidence on reason, not hope. On the other hand, traders who depend on others' opinions live in constant confusion. When a trade goes wrong, they have someone to blame, but they never learn to improve. When it goes right, they give credit to the tip, rather than their own discipline. This dependency becomes a cycle, always seeking external validation, never developing internal strength. Livermore rejected this entirely. He knew that tips, rumors, and crowd sentiment were poison to clear judgment. He understood that once you give up your independence of thought, you also give up your edge. The market is designed to test belief. If that belief comes from someone else, it won't survive the test. Believing in oneself doesn't mean being right all the time, it means trusting that you can handle being wrong. Every successful trader loses, but what defines them is how they respond to those losses. A self-reliant trader studies the mistake, adapts, and returns sharper. A dependent trader blames the market, changes systems, or quits. Self-belief creates consistency, and consistency builds longevity. The market rewards those who can stay in the game long enough to learn its rhythm, and that requires the unshakable confidence to keep going even after failure. True conviction also protects traders from the herd mentality that drives most market cycles. When everyone else is euphoric, the self-believing trader stays cautious. When everyone else is fearful, they look for opportunity. This independent mindset allows them to act when others hesitate and wait when others rush. Livermore often said that the best trades feel uncomfortable when you take them, precisely because the crowd disagrees. Without self-belief, a trader cannot take those uncomfortable positions. They'll wait for confirmation from others, and by the time it comes, the opportunity is gone. The market, at its core, is a psychological contest between conviction and doubt. Prices move not just on information, but on the confidence with which traders act upon that information. The trader who believes in their own analysis holds through noise and reaps the full reward. The trader who doubts themselves exits too soon or hesitates too long. In this way, belief is not abstract. It directly translates into profit or loss. Livermore's rule about self-belief goes beyond trading. It's a philosophy of life. To succeed in any uncertain endeavor, one must trust their own judgment. But in trading, where uncertainty is constant and amplified by money, that trust becomes essential. The market will test you with losses, false signals, and emotional turmoil. The only thing that can carry you through is faith in your ability to think clearly and act decisively. Most traders never develop that inner confidence because they seek safety in numbers. They feel comfort in agreement, but comfort and success rarely coexist in the markets. The 1% who truly win are those who are willing to be alone in their decisions, who trust themselves when no one else does. They analyze, decide, and execute not for applause, but because their understanding compels them to. In the end, self-belief is not about ego, it's about responsibility. It's about saying, if I win, it's because I earned it. If I lose, it's because I have more to learn. That mindset transforms every loss into wisdom and every victory into reinforcement. Jesse Livermore built and lost fortunes, but he never lost faith in his ability to rise again. That, more than anything else, was his secret. The trader who truly believes in themselves doesn't fear the market's uncertainty. They embrace it, knowing that their greatest asset isn't their system, but their self. Charts, patterns, and indicators may decorate a trader's screen, but they mean nothing without discipline and emotional control. These two qualities, often overlooked, are what truly determine whether a trader succeeds or fails. Jesse Livermore knew this well. He understood that trading was not a battle against the market, but a battle against oneself. The game of speculation, he once said, is the most uniformly fascinating game in the world. But it is not a game for the stupid, the mentally lazy, the man of inferior emotional balance, or the get-rich-quick adventurer. In that single sentence lies the essence of this truth. Knowledge can teach you how to trade, but only discipline and control can keep you in the game long enough to profit from it. Every trader starts out believing that success depends on technical skill. They study indicators, master chart patterns, and memorize strategies. They think if they can just learn enough, the market will reward them. But knowledge alone doesn't guarantee success, because the market doesn't move according to logic alone, it moves according to emotion. Fear, greed, and impatience drive prices as much as news or numbers do. That means the real challenge isn't understanding the market. It's understanding yourself in the market. Discipline is the ability to follow your plan when every emotion inside you demands that you abandon it. It means cutting a loss when you don't want to, holding a winning position when you're tempted to cash out too early, and staying on the sidelines when there's no clear opportunity. It means showing up with consistency, even when the last few trades didn't go your way. The disciplined trader doesn't chase excitement, they chase precision. They know that the moment they let emotion dictate their moves, they hand their power to the market. Livermore himself warned that there is nothing new in Wall Street, meaning the same psychological traps that ruined traders a century ago still ruin them today. Lack of discipline has always been the downfall of the majority. Emotional control, on the other hand, is what allows discipline to exist in the first place. Without control, discipline collapses under pressure. The market will always test your patience. It will taunt you with small losses, false breakouts, and sudden reversals. These moments are designed to provoke reaction. Traders who can't manage their emotions fall into the cycle of fear and greed. They panic when prices drop, and they overreach when prices rise. Both emotions are rooted in the same flaw, a need for immediate gratification. The professional trader understands that trading is a marathon, not a sprint. There will always be another trade, another opportunity, another cycle. That perspective only comes with emotional maturity. A disciplined trader acts from principle, not impulse. They don't let the market's mood become their own. When everyone else is euphoric, they remain cautious. When everyone else is terrified, they remain calm. Their edge comes not from predicting the next tick, but from maintaining composure while others lose theirs. This is why two traders can follow the same system and achieve completely different results. One follows it with emotional control, the other with anxiety and inconsistency. The difference isn't the system, it's the state of mind behind it. Livermore's life is a study in how discipline and emotional control separate temporary success from lasting mastery. He made and lost fortunes multiple times, often because when he strayed from his rules, emotions took over. When he followed his principles, waiting patiently for clear trends, cutting losses quickly, and avoiding impulsive trades, he achieved spectacular gains. His experiences showed that trading rules only have power when the trader has the strength to obey them. Without control, rules are just words on paper. The modern trader faces even greater challenges. Technology makes it easy to trade impulsively, to react to every price movement, every tweet, every market rumor. The temptation to act constantly has never been stronger, yet the path to success remains the same as it was in Livermore's time: patience, restraint, and calm under pressure. The trader who can control their emotions in a fast, moving market gains an immense advantage over those who cannot. The market preys on reaction, but it rewards reflection. The irony is that emotional control doesn't mean suppressing feelings. It means acknowledging them without obeying them. Fear, excitement, and doubt will always exist, but the disciplined trader observes these emotions like passing clouds, never allowing them to dictate action. This calm detachments volatility from a threat into an opportunity. It allows the trader to see what others miss, that chaos is temporary, but discipline is permanent. In the end, success in trading is not about how much you know, but how much control you have. A trader can learn every technical pattern in existence, but without discipline, they will abandon their plan the moment it matters most. Conversely, a trader with emotional strength and discipline can succeed with even a simple strategy. Knowledge builds the foundation, but discipline builds the fortress. Emotional control is the guard at the gate, keeping fear and greed from breaking in. Livermore's timeless wisdom reminds us that trading mastery begins where emotion ends. The charts, systems, and strategies are just tools. The true battleground lies within. If you can master yourself, the market becomes your ally. If you cannot, it becomes your enemy. The difference between a losing trader and a lasting one is not brilliance, but balance. The disciplined mind endures, the emotional mind exhausts itself. And in a game that rewards endurance above all, control is the only real edge that never fades. There is nothing new in Wall Street. There can't be, because speculation is as old as the hills. Whatever happens in the stock market today has happened before, and will happen again. Jesse Livermore's observation remains as true now as it was a century ago. The market may change its technology, its participants, and its instruments, but human nature, the real driver of price and panic, never changes. Fear and greed still govern decisions, and cycles of boom and bust still repeat themselves with mechanical precision. The trader who understands this truth gains an enormous advantage. They stop fighting the market and start respecting its rhythm. They learn to endure downturns, to wait through uncertainty, and to recognize that every storm eventually passes. The 99% of traders who quit do so because they mistake temporary pain for permanent failure. They treat every market decline as the end of opportunity, every loss as final, and every mistake as proof they can't succeed. But Livermore knew better. He understood that market movements are simply waves of collective psychology, predictable in pattern, though not in timing. After every panic comes recovery, after every rally comes correction. Those who have the patience and steadiness to stay through the cycle are the ones who ultimately profit. History in the markets does not repeat itself exactly, but it does rhyme. The same emotional traps ensnare traders generation after generation. In Livermore's time, it was ticker tape and rumors on the trading floor. Today it's social media algorithms and headlines flashing across screens. But the essence of speculation remains identical, a constant struggle between human impulse and reason. The trader who recognizes this sees beyond the noise. They stop reacting to every piece of news and start observing the larger pattern unfolding beneath it. Endurance in the market is not just financial, it's psychological. Every great trader learns to survive losing streaks, not because they avoid losses, but because they accept them as part of the process. The market rewards persistence, not perfection. Those who can remain calm while others panic are the ones who capture the rebound when it comes. Patience becomes their most valuable position, one that no one can liquidate or short sell. The repetition of market cycles also teaches humility. The same forces that create opportunity also create danger. When traders forget this, when they believe they've mastered the market reminds them otherwise. Livermore himself experienced this bitterly. He made and lost fortunes not because he didn't understand the game, but because even he was human. Success can dull vigilance just as failure can breed fear. But those who learn from both develop the wisdom to stay balanced through every phase, bullish or bearish, euphoric or despairing. Staying steadfast through the storm requires a mindset that sees beyond the present moment. Most traders get trapped in the short term, reacting emotionally to every tick, every loss, every rumor. They fail to realize that market history stretches far beyond a single trade or trend. The professional trader, however, zooms out. They study the patterns of the past, the psychology of the crowd, and the behavior of price over decades. In doing so, they see that volatility is not chaos, it's opportunity disguised as uncertainty. Patience and steadiness do not mean passivity. The wise trader acts when others freeze and waits when others rush. They are not attached to being right. They are attached to being consistent. They know that every bear market eventually becomes a bull, every sell-off creates the foundation for the next rally, and every period of despair plants the seeds of recovery. Livermore's quote about history repeating itself isn't merely a warning, it's a roadmap. It tells the trader that no matter how dark the moment feels, light always returns. To stay steadfast is to trust in the timeless nature of cycles. Just as seasons turn, so do markets. Those who quit during winter never see spring. Those who panic in the storm never witness the calm that follows. The great traders of history, from Livermore's era to today's, share one defining trait: they endured. They stayed long enough to recognize that the same patterns of greed and fear that cause losses also create opportunities for gain. The lesson, then, is simple but profound. Nothing in the market is truly new. The names of the companies may change, the headlines may shift, and the tools may evolve, but the emotions behind every trade are eternal. The trader who understands this learns not to fear volatility, but to embrace it. They don't waste energy trying to predict every twist. They focus on staying disciplined through all of them. When Livermore said that speculation is as old as the hills, he wasn't being poetic, he was being precise. He was reminding traders that the market is a mirror of humanity, and humanity never changes. Those who endure, who learn from history rather than repeat it, become part of the 1% who win not because they are lucky, but because they are patient. To be steadfast in trading is to know that no loss lasts forever, no rally runs endlessly, and no storm can outlast the sky itself. The market will always test your faith, but those who wait with understanding will always rise with the next wave. Every trader will face that moment, when fear screams louder than reason, when quitting feels like relief. That's the crossroads. Choose to wait. Because just beyond that breaking point lies everything you've been working for.